Good morning. It is Sunday, January 19th, 2025. I'm in a hotel room in Vancouver. Not the best lighting, but we'll make the most of it. It's not really about me, it's more about the slides. I am Robert Sin at CEO Technician on X, at Goldfinger on CEO.c, and this is Goldfinger Capital. And I'm going to talk about Macro Mayhem in 2025 and some really interesting topics pertaining to Trump and China, the Fed, and what could play out in 2025. If you enjoy this video, if you appreciate my content, I give this away for free. Please hit the like button and subscribe to my YouTube channel. I am extremely grateful for your viewership and appreciate your comments, especially on this video. I'm interested to hear some thoughts. I'm sure that some of my opinions are controversial. I think it's definitely, especially the assertion I'll make at the end, is a variant view, definitely not a consensus view. And it could easily not be what plays out, okay? I'm not trying to pretend like I know the future. I think this is an extremely uncertain time in world history and financial markets. So, caveat, strong opinions, weakly held. That's how I operate in financial markets. I think if you stay stuck in one view, when information, data starts to contradict that view and really make it come into doubt, you're foolish. So let's be nimble, let's be flexible, but let's also really understand the structural forces at play here in 2025, and that these two men don't have that many good options here. Okay, so my assertion in this presentation is that President Xi and President Trump will really shape the world for many years to come, and it will likely happen this year. We're early in the year. We have 12 months left, or 11 and a half months. The clock is ticking, and in a sense, both the U.S. and China are facing ticking time bombs. I also think that I know both men will want to come out on top in any kind of trade deal at the bargaining table. They'll want to look good for their populace. They'll want to look like they were tough. And they need to navigate a path where they can both claim that they got a good deal. And that's very tricky. That's not easy to do. The rhetoric started last week, and I think in many ways China has been prepping the field for many months, with their propaganda. It's interesting. I didn't make the slide in this presentation because I had over 50 slides at one point, and I just cut 10 out because it was just too long. And there's no way I can cover every single detail, so I just kind of gave up on that and let's just keep it to 25, 30 minutes. But China had that headline many months ago that they found the biggest gold deposit in history, and it's 2,000, 3,000 meters deep. It's not a new discovery. They just drilled way deeper into the type of gold system that tends to run deeper. So it's not really that big a shock, but they publicized it aggressively. It spread on social media across the world. And for some reason, China wanted to be known for having the biggest gold mine in the world. That's interesting. Friday morning, Trump says he had a good call with Chairman Xi Jinping of China. President Xi and I will do everything possible to make the world a more peaceful, to make the world more peaceful and safe. Okay. So they start off on a positive footing, and even Xi's press people put out positive comments about the call. So kind of smart for both men to start out with a positive outlook and not spoiling the possibilities prior to even, sitting down at the table together. But this is going to be a a tough process, and it's probably not always going to be so cordial and positive, especially, we know Trump is emotional. So let's go through some of the big trends in the world today, important trends that we need to really think about. Why is this happening? What is going on here? So 10-year Treasury yields, we all know that. I mean, everybody can see bond yields have risen. It's been noted by many market commentators that the Fed cut 100 basis points since September, 3 rate cuts in total, 50 basis points in September, and then 25 and 25. And the long end of the curve has done nothing but go up since the Fed started to lower the short end of the curve. So that's a bear steepening of the yield curve. It's bear because bond prices are falling, steepening because the curve is steepening. The longer yields are rising above the shorter yields. And the rising Treasury yields are dragging up yields globally. UK and Canada are following the US, but you know who's not following the US is China. So China 10-year yields are at the lowest in history, and that is a trend, my friend. That is a trend. If I've ever seen a trend, look at this around 2015 time frame, and then this again. Look at this trend. The last decade or so, China 10-year yields have been in quite a downtrend, and it really picked up steam right sort of in the middle or the end of the pandemic, and it's accelerated to the downside in the last year. I mean, this is a very pronounced acceleration from like 2.75 to 1.6%, and it's characteristic of a struggling economy with slowing growth. I mean, the rate of change here is impressive, slowing growth, and maybe even some deflation. So going back to the U.S., we were in a yield curve, inversion, with this inverted yield curve for 2 years, summer 2022 to summer 2024, just uninverted in Q3 of last year. And when the yield curve was inverted for over a year, it became popular for commentators to forecast a recession. This means that there's going to be a recession. It has to, because every time in history, that's what's happened. Then that didn't work, and now it uninverted, and the unemployment rate ticked up 60 basis points from 3.6 to 4.2, 4.3. And then the SOM rule. Well, that's also a signal for a recession. It's got to be a recession. So far, it hasn't. And actually, the bear steepening of the yield curve and the rising 10-year note yield is actually a market signal that the economy is pretty strong and inflation expectations are rising. So unless inflation expectations get way too carried away, too far, and the Fed pivots back to tightening, I don't see the recession coming. Of course, there's other variables, unknowns like China that we're going to talk about that could influence it. But right now, yes, the economy has structurally changed, and some of the indicators we previously focused on are not as insightful anymore. But it's hard to say there's a recession. It's very hard to say that when we're having positive growth and low unemployment. And even though inflation may not be 2%, it's still not very high, 3%. Some people might argue with me about that, but in the grand scheme of things, there's been worse economies out there than the U.S. economy today. Now, the Fed cut 50 basis points back in September. And that was kind of a shock. I think that surprised a lot of people. But the economy was looking bleaker 4 months ago than it is today. And you can see this, this index from Bloomberg bottomed in August, and it had a very nice run up into November. Now it's just sort of around the flat line. But, again, it seems like whatever crisis that we may have been heading to in August, September, was averted, and maybe that 50 basis point cut was a good thing the Fed did. they got criticized for it, but I'm not sure it was a bad move. And it's really important to understand the yield curve signals because they're pretty powerful. This bearish steepening says that we're now in the boom cycle that favors commodities. Commodities. So things like copper and oil, natural gas, and maybe gold, right? So we'll talk more about that. But that's an important signal for investors to really clue in on is Trump 2.0 is entering office. He wants number go up. He wants the strongest economy ever. He wants to be able to get on the podium and talk about how great he is and how great everything is, and he made America great again. That kind of aligns with the bear steepening boom thesis and commodities. So does onshoring and reshoring of the U.S. supply chains, bringing manufacturing back to the U.S. That all aligns with a boom and a commodities bull market. Now, the dollar is becoming a little problematic. One of the things that Trump has been very vocal about for months is the U.S. dollar is too strong, and some of our trading partners like China, without going explicitly and calling them out, but their currency is too weak. It's artificially weak, essentially, and using the word, including his Treasury nominee, rebalancing. So that's a nice way of saying you need to allow your currency to strengthen or free float, or you need to do something, internally to increase consumption inside of China so we can rebalance our trade, right? It's a one way, it's not totally one way, but whatever, it's 500 billion or so flowing from the U.S. to China every year. So the dollar is very overvalued. Now, there's another reason why the dollar might be overvalued. We'll talk about that in a second. So look at this chart. This is not the U.S. dollar index chart. This is a broad effective exchange rate minus CPI chart. So it's a little complicated, but let's just look at the levels. The most overvalued in history was January 1985. What happened in January 1985? The Plaza Accord. So all these countries and central bankers went to the Plaza Hotel in Manhattan, and they made a deal to agree to weaken the U.S. dollar against currencies like the yen. Well, what did the dollar do for the next 10 years? It basically fell. Here we are again. So we may not get a Plaza Accord or a Mar-a-Lago Accord that, knocks the dollar down 50% in a month, but we might get something else that will start to weaken the dollar more gradually. I'm not sure it's going to be quite as violent as this late 1980s move was, but who knows? There's so many unknowns here. And that's really why we need to be in the question. We need to pick up on clues and hints that Trump's new Treasury Secretary drops, or maybe Powell drops, the Fed chairman, or any clues that we can pick up from China. So with Trump entering office officially tomorrow at noon, probably start signing executive orders tomorrow night, although tomorrow is a federal holiday in the U.S. He will hit the ground running on Tuesday. The 21st will be his first real full day in office of the president in the Oval Office. There's a lot of uncertainty what's going to happen here. We have some clues, obviously, but there's a lot of different permutations in how this could go. So trade policy index, the uncertainty level is super high. It's the highest it's been since 2020, the global pandemic. Now let's clue in on some hints in the press in the last week from Fed and Treasury. So Fed Governor Waller says rate cuts are possible in the next few months. 3 or 4 cuts could be possible this year. I don't think March can be ruled out for a rate cut. Hold on. Just like 2 weeks ago, the market was basically pricing in one rate cut max and maybe even none. March is totally off the table. May was like 10 or 15%. What's happening? Well, we'll talk about that in a little bit. This is a big clue because Waller is long thought to be Powell's closest Fed governor, who really aligns with Powell's thinking. So the fact that he is explicitly stating that March cannot be ruled out when the market has ruled it out, that's big. It means that they see more uncertainty than the market does, and they're a little more concerned than the market is. That's very, very interesting. And 4 rate cuts this year, that would be 1 per quarter. March, June, September, etc. I mean, that's pretty aggressive. That gets us down to 3.5 on the Fed funds rate by the end of the year. The market is not there. The market is still thinking about 4%. 1 rate cut, maybe 2. Now, he said possible. I understand that doesn't mean probable. But still, the fact he would say that, he knows he's signaling to the market. And then Trump's Treasury nominee is a super sharp guy who clearly has some plans that he's ready to put into action. He's telling us that tariffs are not inflationary as long as you don't raise the money supply overall. You don't do big stimulus packages or QE. Tariffs can't be inflationary. That's interesting. And one of the slides I took out, because again, I had like 56 slides, was the one that shows the difference between Wall Street inflation and Main Street inflation. So tariffs can raise the price level one time, boom, up. And then they taper off, right? They're not doing 10 tariffs, they're doing 1 tariff hike, right? But it also can suck money and resources, away from other sectors of the economy and other goods and services. So I get his point that on net, tariffs might not be inflationary, but that's certainly not the way most people see it. And I'd have to think that if you put 60% tariffs on Chinese imports overnight, 3 or 4 months later, the CPI numbers are going to be pretty hot. I don't know. That's just me. That's just my thinking. Maybe on net, if we look over a long time period, the net effects aren't that big because probably if the tariffs are too large, they're hurting the economy, right? They're hurting the consumption, the overall consumption in the economy. I mean, if suddenly the price of something that I was buying a week ago is now 60% higher, I'm just not going to buy it, right? Probably. It's complicated. The whole tariff thing with China is really complicated, and I'm not going to spend any more time on it, but clearly they're thinking about tariffs very seriously. And then this is the real shot across the belt. China has the most unbalanced economy in the history of the world. They are in a severe recession / depression. Depression? China's in a depression, he says. That's a big word. They may have negative 4% disinflation. You could call that deflation. Disinflation. So that's a subtlety, and I think he really meant to say deflation, because the other word means, well, we're at positive 4% inflation, and then the next quarter or the next year we were at positive 3% inflation. So still, the inflation level, the price level is rising, but the rate of change is falling. Deflation is actually the price level is falling, and that's what the Chinese data states. The PPI data is showing that price levels are declining outright. They need to do a much needed internal rebalance. Much needed internal rebalance. What does that mean? I don't know. We're going to maybe try to figure it out. A complex macro backdrop. Fed policy uncertainty is super high. Trump is a disruptive force. And this is what you need to understand. So China is this massive aircraft carrier of a country, economy, $19 trillion economy with the biggest banking system in the world, property bubble, debt deflation cycle in full swing. And Trump comes in and he's this big gorilla that wants to just shake up all these countries in the world and have things his way. So the status quo will no longer work for trade, for China, for the Eurozone, for NATO. Trump is this big bully that's going to shake everybody and say, you're going to have to do it different because I said so. You can't rip us off anymore, making America great again. So the status quo is gone Tuesday morning, Monday night, and then a new world is going to have to be shaped. And that's the thing to figure out. What is this going to look like? How is this going to play out? And this is where I think there could be big mistakes made in financial markets, and there could be huge opportunities. Trump's ideas, deglobalization, tariffs, onshoring, I mean, taking stuff, manufacturing from China, mining from China, and moving it to the U.S., how is that not inflationary? In China, at a copper mine in China, they could pay their workers 50 cents an hour. In the U.S., we pay them $50 an hour, right? In China, you can get a mining permit in 6 months because the government just says yes. Don't do any deeper analysis. Just give them the permit. In the U.S., it's an 8-year permitting process that costs tens of millions or hundreds of millions of dollars. So how is bringing all of these industries back to the U.S. not massively inflationary? I don't see it. Maybe somebody in the comments section can teach me how onshoring Chinese manufacturing back to North America is not extremely inflationary. How are tariffs not inflationary, at least in the near term? Maybe not long term. It might all even out over long time periods, but in the near term, it could be a shock, right? And I think this is the biggest thing, the biggest 2 bullet points to understand. China's facing a debt deflation. So really get that. Debt bubble, property bubble, bad loans, basically assets on balance sheets that are marked at fake prices, fake accounting. Yeah, just think of China as fake accounting. The numbers aren't real anywhere, right? So when the numbers aren't real, people don't trust anything. They don't make investments. They pull back. They stockpile gold. They might just hoard cash, like actual paper currency, right? They just don't trust that their bank will be there tomorrow. They don't trust company financial statements, right? And that's extremely anti-growth. That's extremely negative for the economy overall. It's deflationary. And that is what China is facing, a debt deflation. They need to reinstill confidence and do something drastic, something shocking. Shock and awe. That's probably the best way I can say it. And then the U.S., this debt wall, $7 trillion of U.S. Treasury debt needs to be refinanced in 2025. $7 trillion. So this debt wall that the Treasury has in 2025 is part of what is driving up the dollar, because investors are getting ahead of the fact that the Treasury is going to suck all these dollars out of the system in 2025. When they sell Treasury debt, they receive dollars from investors, into the Treasury bank account. That takes dollars out of the world pool of dollars, right? The dollar, supply drains. And especially if the Treasury under Trump sells some of that $7 trillion in longer dated bonds, notes, 10, 20, 30, that's going to be really hard to swallow, right? I believe he's going to have to cram it all at the front end on 2 years, the 2-year note or the bills, the 12-month, 3-month bills. But we will see. This is a serious debt wall that is coming, and it's causing a US dollar short squeeze that has the potential, and this is sort of this dollar milkshake theory, right? The dollar is the reserve currency. Everybody's got their reserves, their assets, and even their debts in dollars. And when there's a squeeze for dollars, when dollars are in short supply globally, and the Treasury is sucking dollars out of the system trying to refinance the government debt, you can create a massive short squeeze. And it's a positive feedback loop where just higher prices will create an even bigger squeeze. People rushing for dollars, flight to safety, stock market start to fall, flight to the dollar, eventually triggering a financial crisis. So this is very real. This is a very real threat that we face walking into 2025. Trump wants a weaker currency. When was the last time the dollar was as strong as it is today? Early 1985. We know it happened. The Plaza Accord. So China is a dollarized economy and depends on the U.S. in many ways. On the other hand, the U.S. depends upon China for raw materials and refined products. And we exported our manufacturing economy to China a long time ago, right? So we need each other. The U.S. and China cannot fight a trade war. They definitely cannot fight a real war. That would be disastrous. Trump's going to just have to give Taiwan to China as part of any deal. There's no way the U.S. people, the U.S. military is going to fight a war over Taiwan on the other side of the world, right? So these are all part of the chips on the bargaining table, and I expect that Taiwan will probably be part of the bargaining chips. This is interesting. So whatever the total government debt is officially 35, 36 trillion. The deficit is about 2 trillion. 2 trillion deficit. Tax receipts falling in the first quarter of 2025. The government's on a different calendar year than the rest of us. It's a different fiscal year. So tax receipts were down in Q1. Spending was up. Spending is up. Spending is up. And interest costs are up. Of course they're up because interest rates are high. 4.7, 4.8% on the 10-year. The Fed just cut to 4.5, but still that's a relatively high interest rate to where we've been at the last decade, right? So $711 billion fiscal first quarter deficit. That's an annualized rate of over 2.8 trillion. We're knocking on that 3 trillion now. Trump is inheriting a fiscal mess, a fiscal quagmire. I don't know what to call it. It's out of control, right? These trends, I mean, just look at the trends. Look at the trends. The numbers are getting bigger. The deficit is bigger than it was at the same time last year, right? The rate of change is increasing. And the interest costs are getting bigger on a bigger overall pool of debt, right? It's at a breaking point. I'm not sure the system breaks tomorrow, but if these trends continue for, let's say, another 2, 3, 4 quarters, I believe there is that red line level where all of a sudden, problems, failed Treasury auctions, the bad stuff happens, right? And then look at the forecast. So, these aren't my numbers. This is the CBO, the OMB. So 2 trillion, basically, deficit. And, even though Trump says he's going to cut the deficit, I don't know. I'm kind of skeptical. And then look out, many years into the future and look at some of these deficits that occur in the early 2030s, right? And by the way, these numbers are always wrong, and they're always too conservative. It's been proven year after year. 2020, they made a budget forecast. It was 7 trillion or 6 trillion bigger. 2021, they made a budget forecast. It was 1 trillion more, blah, blah, blah. It's always bigger. It's always bigger, guys. Here's this debt wall. That's big. That's 7 trillion. That is big. I believe placing some of this Treasury debt will also be part of any China deal. We give China some things it wants, and they give us, yeah, we'll take 300, 400 billion of that 7 trillion off your hands, no problem. Just leave us alone on Taiwan and whatever else, human rights abuses we're doing in Mongolia or what have you. Just don't worry about it, okay? And TikTok, give us TikTok back, right? And then even after we get through this 7 trillion year, well, next year's almost 4 trillion. That's not exactly a small number either, right? So really strong dollar, rising treasury yields, and rising inflation expectations with Trump's plan to further deglobalize and do big tariffs. Yikes. That's quite a toxic brew for the cost of all that treasury debt and the potential for the dollar to squeeze even further. So let's turn to China. China's banking system, biggest in the world, 56 trillion. Big, more than double the size of the U.S. So the U.S. economy is 29 trillion, China's 19 trillion, yet somehow has a banking system more than double the size of the U.S. So the U.S. has the deepest, biggest financial markets, an economy more than 50% greater the size of China, but somehow China has this enormous banking system. Why? Because they focused on creating a property bubble for 20 years. And the bubble really started to burst in 2020, 2021, as the pandemic hit hard, and they couldn't play the same games and kick the can down the road they had done previously. The numbers, which are not even right, they're always going to be portrayed better than they really are. But even the numbers we get show new home sales falling 26.8% during compared to the same period last year, and that follows a 19.7% drop in the month before. Right, so the trend is worsening in the residential property market in China. China's total debt to GDP ratio is over 300%. That is enormous. Again, those numbers are faked up, right? You had to actually dig deeper and really understand how the economy is structured to get to that 300% number. Off-balance sheet local government debt's at 8.9 trillion. When you think about that, that's local governments. That's like county and state level. 8.9 trillion? Wow. That's 50% of China's GDP. That is also a lot of bad property loans. And then, basically, officially, this property bear market started in 2021. Well, so far, the average size of the correction is 11.5%. And the average, bear market decline following a property bubble is minus 41%. So China could have a bit further to go, right? We're only 3 years into it. These often take 7, 8, 9, 10 years to play out. So it's a deflationary environment that further strains the insolvent banking sector. And Trump 2.0 stands to be a wrecking ball to knock through China's already ailing economy. Demographic crisis in China, population is falling. It is falling, just like the Japanese. Since like 2010, their population is declining. Fewer young people taking care of more older people. China built its economy around real estate. It is an enormous share of its GDP. There's those CPI and PPI I was talking about. So PPI is deflationary. Downward shift in the yield curve in China. Again, confirmation of debt deflation economy. They can fake up accounting statements, balance sheets, and income statements. It's harder for them to fake up market pricing. And there's the GDP growth. Well, speaking of trends, if you ignore trends like these, you are really doing it wrong. That is a pronounced, powerful trend, and it is likely to continue. And these are based upon official numbers that are fake. So it's even worse than this chart makes it out to be. Fiscal deficit percent of GDP. So again, this is the augmented numbers from the IMF, and this is still too conservative. The numbers are even worse. The China's deficit is even bigger. There's that debt to GDP, right? So it diverged, with the U.S. and the Eurozone. So let's talk about what could play out here, right? So Trump has publicly stated possibility of 60% tariffs on all China goods that are entering the U.S., deporting undocumented immigrants, extending 2017 tax cuts. So remember those deficit numbers? Well, add another 4.6 trillion to those numbers over the next 10 years. So that's basically another 500 billion a year. Well, Trump wants to save that by reducing spending by 1 trillion annually. Well, good luck on that one. He's basically going to swap tax cuts for the American people for cutting the size of the federal government. He's going to get a lot of pushback. It's going to be a painful process, not easy. And it won't happen overnight, because even if he lays off 20,000, 30,000 federal employees, he's going to have to give them severance packages. That will be part of the 2025 budget deficit. That'll actually make it bigger, not smaller, even if it saves money in 2026, out into the future. And again, he's a one-term president, so 2028 rolls around, and then the next guy comes in and could reverse the whole thing and add back those 30,000 federal government employees, or whatever the number is. I just made that up. Renegotiating trade deals, and then shaking down NATO partners like Canada and the EU for more protection money for NATO. He's got some bold plans, not making friends with certain countries. And because of, the fact they know Trump is coming, and these tariffs are potentially coming, and a bunch of executive orders are coming, there has been a rush to move metals into the U.S. from abroad, right? So the COMEX is seeing a lot of silver coming into its inventory, a bunch of gold coming into its inventory, and copper. Has anybody noticed the 10% rally in copper early in the new year? And also gold has been pretty robust. The dips are being bought. Higher highs and higher lows off of a bottom made near 2,600 on one of the last days of 2024. So the market is telling us that they believe Trump with some of the things he's saying. 2024 was a stellar year for gold. It's hard to really understand how good of a year 2024 was for gold, but when you look at it in Australian dollar and Japanese yen, 40%, 41.7%, like, in those countries, in those currencies, gold appreciated enormously in 2024, right? And it's just across the board. Here's the daily chart. Gold, I think we pulled back a little bit on Friday, so maybe this is 2740, but still, this is a nice breakout. Let's see if it has follow through from a 2-month pennant pattern, a well-constructed pennant pattern where you have the low, the higher low, the high, the lower high, and then it busts out. Let's see if it can get above 2760. If it can break this high from last month, I think new all-time highs are right around the corner. And also, remember that this recent gold strength the last month is happening in the face of rising Treasury yields and a rising dollar. Yeah, they pulled back a little bit at the end of last week, but still, gold is unmoored from these correlations, right? We've been taught and we've learned for the last couple of decades that if the dollar is super strong, gold should fall in dollar terms. If yields are rising and real interest rates are rising, gold should fall. Well, throw those correlations out the window, because the whole thing changed in mid-2022, and obviously that had to do with the Russian invasion of Ukraine. So why is this happening? Well, really, I got 7 bullet points here, but let's just simplify it to this, that relentless central bank gold buying, BRIC central banks, global central banks, but really, I believe the primary driver is China, and we'll talk about that shortly. So these are the official numbers. China held in official, reserves. Supposedly, they took a 6-month break at the end of 2024, and they resumed their gold purchases at the very end of last year. It's interesting. They resumed them in November, What else happened in November? Oh, U.S. election. I feel just by the way gold is trading that in January they're probably buying even more. They're probably buying 20 metric tons this month, rivaling some of their bigger months in 2023. The price of gold in Chinese yuan, CNY, the renminbi, is at an all-time high, basically 20,000 per ounce. But this is the real story, guys. And this is Jan van Nieuwenhuis. I'm not Dutch and I'm not good at pronouncing, but he does excellent work. And he really got to the bottom of this stealth secret China gold buying. Now, many months ago, I did a video about secret Saudi buying that he clued in on. Well, Saudi is a small fish. China is the big fish. And basically, the orange numbers are what's reported to the IMF, but the blue is the gap between what the World Gold Council sees central banks in total buying versus what the IMF is, reporting that China is buying, right? So if you take all the other central banks and what they report, and then what China reports, but the total buying that the World Gold Council sees, well, there's a gap. Somebody is not telling the truth about how much they're buying, and that somebody is China. It can only be them, right? And so the amount that they underreport their gold purchases, I mean, we're talking well above 1,000 metric tons, maybe on the order of 2,000, metric tons over the last 4 or 5 years, right? And so their official gold pile is like 2,300 tons. Well, I would assert that it's likely at least double that and potentially triple that. And that's the People's Bank of China. That's the Chinese government stockpile, right? And that, the notional dollar amount if they had double what they state publicly, it's about $500 billion. If it's triple, it's more like $750 billion. And, it's interesting, like look at the drop in China's Treasury holdings since 2021. It's down about 300 billion. Treasury holdings down about 300 billion, and potentially their gold holdings are understated by 250 billion or so. Maybe just they're selling treasuries and buying gold for the last 3.5 years. I don't know. It's a theory, and nobody knows the truth. Maybe somebody in China does, but it'll be interesting to see if China reveals a bigger stockpile at some point in the next year or so as a trump card, pun intended. Now, clearly, we know there's a de-dollarization process going on globally. It's been going on for more than a decade, and it definitely started to pick up a little steam after mid-2022, and you can see in 2024 it's really starting to accelerate. Maybe the dollar share of global, reserves is probably maybe bound to 56 or 55% by now. Still the big player, but not just an incredibly dominant player that it was in 2015 when it was 66%, 2/3 of global, reserve currencies. It's a slow and steady process, and because the dollar is such a big elephant, it's this giant currency, the global, reserve currency since Bretton Woods in 1944. It's not easy to get off of. Gold holdings in reserve assets, that's a trend. This was a trend that led to a tremendous gold bear market in the 80s, 90s, and early 2000s. And then a major bottom happened right at the global financial crisis, 2008, 2009. And look at the trend since, right? Look at the trend since the global financial crisis. There's a very clear and powerful trend. And remember, these numbers are all understated. They're buying more than they officially state, right? If you had an essentially unlimited bankroll and you knew you wanted to buy one specific thing, buy as much as you could without driving the price up too much, you wouldn't tell people exactly how much you're buying. In fact, you might not even tell them you're buying it at all, right? So China is a rational actor here. The BRICS, all these different central banks accumulating gold. So it's not just China. It's not just China. It's a global phenomenon, but China is the leader and the biggest fish in the sea. And, you know, the gold price, like most commodities, is set on the margin by speculators, people who buy and sell fast, hot money, drive it up, drive it down. But over the long run, so the speculators set it in the short run, but in the long run, financial and monetary authorities, central banks set the gold price. And just look at the trend, the yellow line. Look at the trend, especially the trend since 2015, right? Gold has jumped from $1,045 an ounce to $2,745 an ounce since early 2016. And so this is the tricky part of the presentation. What does China do, right? We know they have a big trade surplus. Their economy is focused on exports. They have a debt deflation inside their economy. Falling prices, right? So when prices are falling, there's not enough money chasing the goods and services to keep the price level up and or rising, right? Stable or rising. So debt deflation. Deflation is too little money, and that's a result of too many insolvent assets. Okay, it's not that complicated to wrap your brain around it. It's kind of what happened in the U.S. in 2008. All those overinflated houses, and then prices dropped 50%, and then all those mortgages were bad, and so then everybody had losses and was essentially broke, right? So when your net worth drops from $1 million to zero in a month, well, your consumption in the economy is going to drop off a cliff too. You just don't have the resources to continue to go out to dinner, to take trips, to buy goods at stores, et cetera, right? So that's what's happening in China. And also the fact that their accounting is fake, right? Like China is the king of fakery. We know what happened when the U.S. allowed all these Chinese companies to list in the U.S. There were all these frauds, just like one fraud after the next. So, and I'm not anti-China. I'm just calling it like I see it. Okay, I'm just calling it like I see it. In fact, I very much like China because I think China's going to make my gold worth more, and maybe my gold stocks worth more too. But I believe that China's response is going to be multifaceted, and China is going to use gold as the U.S. did in 1944 at Bretton Woods. So Bretton Woods, why did the dollar become the standard? Like, why did the dollar become the global currency? Because the U.S. had 20,000 metric tons of gold in 1944. The U.S. had been living on a gold standard since its inception, basically. And then the government in 1933 said, the private citizens can't own gold. You've got to sell it all to us. So then the government became the biggest gold owner. And then the U.S. ran surpluses for a period of time. And then the war happened and even more gold came into the U.S. And 1944 happened and everybody agreed the U.S. is going to be the victor of World War II. The writing was on the wall at that point, and the U.S. has all the gold. So the dollar is the reserve currency. Boom. China is going to not be the reserve currency, certainly not overnight. That's not going to happen. But they can certainly assert their strength and show their gold assets to the world and say, well, the dollar may be the biggest now, but now you have another option, right? And maybe even there could be an aspect of what China does that does a partial peg or a tokenized gold-backed yuan. There's lots of different options, and I'm sure they've got a lot of smart people figuring out what the possible moves are. But I don't think the path is set in stone. It's a game theory calculation. What does Trump do? What does Xi do? What's Trump's response? What's Xi's response, right? And they have different options on the table for how they can respond to different threats and different offers. But we know that China has been, so just really get clear, China has been buying a lot of gold. They have continued to buy gold relentlessly, even when the dollar was strong, even when Treasury yields were rising, even when the economy was really uncertain in 2022. They kept buying gold. They kept buying gold. They're buying more gold. They're not publicly, revealing how much gold they've actually been buying. So there's been secret buying. Why? What are they thinking? Why are they doing this? And that's what you really need to think about. China is a very big player, the number two, economy, basically in the world. Yeah, I know the EU, the Eurozone, but I'm going to assert that China is more important at this point. And in a lot of ways, China's economy, if they get their shit together and this rebalance happens, it's possible that China could overtake the U.S. in terms of total GDP in the next decade. It's possible, just because their population is so large. But they also have all those structural challenges, including the growth rate, the dropping population growth and the aging population. It's complicated, and I'm not going to go further down that road. But there's potential for the yuan to devalue against the dollar in 2025. And actually, this is sort of more of a consensus thinking, is that they're going to go from like 7.3 to 8 or 8.1. And that will help to ease sort of the debt burden, right? And then their goods become even cheaper. But the problem with that, and I should have added a note to this bullet point because this was a possibility. This is not my prediction. The problem with that is that's just going to piss Trump off even more. And then he's going to put on even bigger tariffs, right? So that may not work. It might work, internally for some time, but I actually worry if they devalue too fast, it just creates a pernicious cycle where the value of the currency that's already not moving, it's not moving around fast enough in the economy, becomes worth even less. So then there's even less consumption, right? So I actually don't think, so basically strike a red line through this, I actually don't think that devaluation is going to be the move. It could be part of a threat at the bargaining table, but I don't think it's actually going to be their move. Trump is probably going to threaten tariffs. He may start to implement tariffs gradually as they sit down at the table and work through a deal. But also, tariffs are not a free lunch for the U.S., and it could dent business confidence and put upward pressure on the unemployment rate, and that would bring the Fed back in with easing, right? If the unemployment rate rises, if business confidence starts to fall, and if the Fed starts cutting again, the dollar is going to fall, right? The dollar is going to fall. So Trump will get his weaker dollar at the cost of some other painful things too, right? He'll get his tariffs and he'll get his weaker dollar. He won't get his great economy. But the Fed will probably view price rises from tariffs as one time, transitory. There's that word, transitory. And they'll shift to a more dovish policy stance. So I believe Waller is previewing what he sees coming. He's skating to where the puck is going, not to where it is right now. If the economy stays like it is right now, I don't see 3 or 4 rate cuts in 2025. But he sees these first 3 bullet points coming, the first 4, and the Fed's going to cut. The Fed's going to have a dovish surprise. Also gold bullish, also dollar bearish. And because of the $7 trillion Treasury debt wall, because of the high interest costs of the debt, we'll probably get yield curve control between the Fed and Treasury by the end of the year. And how that works, it can work a few different ways. So Treasury could do it by itself by just jamming all the new supply on the front end and then using the dollars to buy the long end and bring the long end yield down. There's a few different ways that they could work it out, but it'd probably be stealth. It probably won't be explicitly stated, but you'll start to see the 10-year drop, and you'll start to see risk assets rise, a dollar fall. Gold might go apeshit, right? But most likely they're going to work out a deal that reduces the U.S. trade deficit with China. If there are tariffs, they'll be well telegraphed, in advance. The market won't be shocked. And the U.S. will implement export subsidies. So they'll take the money they receive from the tariffs, and then they'll use that to stimulate and subsidize U.S. manufacturing base and securing U.S. supply chain. So is it a revalue or devalue CNY move, right? And my variant view, my crazy idea, is that they will eventually revalue higher versus the dollar. And they might even do a partial dollar peg. So how that might work is something like they might be like, okay, we're going to go 6-1 versus the dollar. So right now it's 7.3 CNY to the USD. They're going to go to 6. So fewer CNY to $1 means the CNY appreciates. Let's just call it ballpark 20%. And then they hold the CNY price of gold at 20,000. So they don't let it drop because the CNY appreciated. They hold it. So they're basically saying we're not pegging to the dollar, we're pegging to gold. They won't do a standing peg. They won't buy 10,000 tons or 20,000 tons. It won't be unlimited. But they could do something like either just keep buying in the market to drive the price up, or they could just say, look, we got a bid for 1,000 tons at 20,000 CNY per ounce. If you want to send us your 400-ounce gold bars, we'll buy it up to 1,000 tons at that price. That will probably move the market in itself, and they won't even be able to buy the 1,000 tons because the market will move, ahead of it. So whatever, gold is 27.45 now. If they do that, gold will be over 3,000, maybe 3,300, I think. So all of a sudden, all of the Chinese people gold wealth appreciates in purchasing power, allowing them to do more consumption, right? The Chinese people probably own 30,000 tons of gold. So the central bank officially owns 2,300. The total Chinese, 1.4 trillion population, owns 30,000 tons of gold, more than 10x the central bank, right? So if all of a sudden that huge gold float in China suddenly is worth 20% more on a purchasing power parity basis, well, now you have stoked consumption and inflation inside of China, right? And you don't just do that, you also do a fiscal stimulus on top of it. You do a massive fiscal stimulus, right? And you basically made all your gold stockpile across the country worth what, $1 trillion more overnight. Well, now you can take that trillion and do a stimulus, an ocean of fiscal stimulus. So you're making your people wealthier, and then you're showering them with more yuan and saying, consume internally. Consume internally. And those of you with bad assets on your balance sheet, take the losses and recapitalize because now there's more money in the economy. I don't know. It's my crazy theory, but I don't think devaluation is the way to go. I think devaluation could create an even worse crisis for China and possibly for the U.S. I think that would be bad. I think if you see the PBOC start to devalue, then the tariff war is ratcheting up. And that's when you want to actually short risk assets. A financial crisis could be triggered. Gold could be volatile. It could drop at first in that outcome, and then it could rise even sharply as the crisis ramps up, and the Fed has to take out its bazooka again, like it did in 2020, right? It's complicated, guys, and this has already been a long video, and I've got a long day ahead at conference, Vancouver Resource Investment Conference. Thanks for tuning in. Again, if you enjoyed this video, if you enjoy my content, please hit the like and subscribe button, and feel free to share it with your friends, family, and community. Have a powerful trading week, and go Eagles.